We're going to talk about the 5 key steps in the mortgage underwriting process. This article was sourced from bankrate.com, written by Jean Lee. You can reach her Twitter at Bankrate. So Jean Lee, Twitter at Bankrate. Okay, let's get into it. Okay, so if you're like most people who buy a home, you'll take out a mortgage to finance the purchase. The process that mortgage lenders use to assess the creditworthiness and determine whether to approve you for that loan is called underwriting. Here is what you need to know about the mortgage underwriting process. What is mortgage underwriting? Underwriting is a mortgage lender's process of assessing the risk of lending money to you. The bank, credit union, or lender has to determine whether you are likely to be able to pay back the home loan before deciding whether to approve your mortgage application, and does this through underwriting. Okay, before underwriting, a loan officer or mortgage broker collects as many documents necessary for your application. As underwriting then verifies your identification, checks your credit history, and assesses your financial situation, including your income, cash reserves, equity investment, financial assets, and other risk factors. Many lenders closely follow underwriting guidelines from Fannie Mae and Freddie Mac. Automatic underwriting versus manual underwriting. A mortgage underwriter can assess your loan application manually or run it through a software program known as automatic underwriting to determine whether to approve you for a loan. Automatic underwriting is usually completed faster than manual underwriting, but since a computer is doing the evaluating, it has some limitations that might not make it ideal for borrowers with unique circumstances such as inconsistent income. In these cases, it can be easier to qualify a borrower through manual underwriting as opposed to automatic system. Sometimes, too, lenders use a combination of automatic and manual underwriting in order to gauge risks. What does a mortgage underwriter do? A mortgage underwriter's job is to assess delinquency risks, so meaning the overall risk that you will not be able to repay the mortgage. To do so, the underwriter evaluates factors that help the lender understand your financial situation, including your credit score, your credit report, and the property you intend to buy. The underwriter then documents their assessments and weighs various elements of your loan application as a whole to decide whether the risk level is acceptable. Here's an example from Fannie Mae's underwriting guidelines for a single-family home that's to serve as a primary residence. Assume the lender typically requires the following: maximum loan-to-value LTV ratio of 97%, credit score of 640 or higher, maximum debt-to-income or DTI ratio of 36%. If a borrower falls short in one area, the loan might still be approved based on the strength of the other two factors, and/or factors such as whether you will occupy the property, amortization schedule, type of property and how many units it has, financial reserves or assets, investment accounts, retirement accounts, savings in the bank. So if you had a higher DTI, say 40%, you might get approved for a mortgage as long as you have a better credit score. If your LTV ratio was lower than 97%, you might be able to get mortgage approval even with a lower credit score like 620. How long does mortgage underwriting take? The mortgage underwriting process can take anywhere from a few days to a few weeks, depending on whether the underwriter needs additional information from you, what demand is like for the lender, and how streamlined the lender's practices are. The quicker you compile your documents and respond to the lender's request for information, the smoother and speedier the process can be. Keep in mind, however, that underwriting is just one part of the overall lending process. You can expect to completely close on a loan in 40 to 50 days. How strict is mortgage underwriting? In 2020, 9.3% of applications for a home purchase loan were denied, according to the Home Mortgage Disclosure Act data. For the most part, mortgage lenders follow specific standards for the loans they originate. For conventional loans, lenders adhere to the Fannie and Freddie Mac standards because if a loan meets those requirements, the lender can sell it on the secondary market and use that capital to create more mortgages for more borrowers. For an FHA, VA, USDA loan, lenders follow the guidelines of the Federal Housing Administration, or FHA, Department of Veterans Affairs, VA, and Department of Agriculture, the USDA, which guarantees or insure those types of loans if borrower defaults. So the lenders also have to account for the business of making mortgages. They can't take on more risk than what their operation supports. So in addition to baseline loan standards, lenders can impose additional requirements known as overlays. Sometimes lenders implement stricter protocols in response to economic volatility. Throughout the pandemic, for example, many lenders began requiring higher credit scores and larger down payments. They said some lenders can be flexible, such as allowing a borrower to qualify based on assets instead of income. Applying for a mortgage, what to expect. When you submit a mortgage application to a lender, you'll need to include extensive financial documentation such as your W-2s, forms, pay stubs, bank statements, and tax returns. When underwriting the application, the lender might come back to you with questions about these documents or requests for additional information. Responding to these requests quickly will help speed up the mortgage underwriting process. Here's an overview of the steps to getting a mortgage. Getting pre-approved. Your very first step, even before you start looking for a home, is to get pre-approved for a mortgage. To determine whether you're pre-approved, a lender will review your financial information such as your income and your debts and run a credit check. Keep in mind that getting pre-qualified and pre-approved mean two different things. In general, a pre-approval serves as an indication from a lender that you will be approved for a certain amount of financing, provided your financial situation doesn't change. A pre-qualification is simply an indication that you could be approved for a loan. Attaining a pre-approval usually requires you to furnish more information to the lender compared to a pre-qualification. Number two, income and asset verification. Be prepared to have your income verified and provide other financial documentation such as tax returns and bank account statements. Assets that will be considered include money in your bank accounts, retirement savings, your investment accounts, the cash value of your life insurance policies, and ownerships in businesses where you have assets in the form of stock or retirement accounts. If you're deemed qualified, your lender will issue a pre-approval letter stating that it is willing to lend you a certain amount based on the information you provided. A pre-approval letter shows the seller that you're a serious buyer and can back a purchase offer with financing. You can use bank rates mortgage calculator to figure out how much you need. Okay, number 3, the appraisal. Once you found a house you like that fits your budget and have made an offer on it, a lender will conduct an appraisal of the property. This is to assess whether the amount you offered to pay is appropriate based on the house condition and comparable homes in the neighborhood, or comps. The cost of an appraisal for a single family home varies from a few $100s to over $1,000 depending on the complexity and size of the home. And note on this, whether or not it's included in your closing or HUD-1 statement from the title company or the bank statement of closing, preliminary statement of closing, you notice that that you will get a bank will order the appraisal. However, you yourself as the home buyer or investor will have to pay up front this cost. It could be anywhere from $500 to $600 on the most part, depending on where you are in the country or what city you're in. And basically, you do nothing. You just let the bank do the order the appraisal. You can't order the appraiser for obvious reasons. And you just but you will receive from the title company or from the bank the information of the appraiser in order to, or information on where and how to make the payment. And the appraiser's opinion is very, very important in this process, because the bank is going to lend you pretty much, say like if you're doing conventional, the bank is going to loan you up to say 80% of the value of the home, or LTV, loan to value. So if you have a $100,000 home, the bank will lend you $80,000, and you have to come up with 20% or $20,000. So this doesn't include closing costs, but we're going to say, just to make everything simple, that closing costs, down payment, everything is all in that $20,000, and the bank lends you the $80,000. So if the appraiser comes in at say $95,000, there's a like $5,000 shortage there. So either you're gonna have to get with your realtor or with the seller or seller's agent and figure a way to renegotiate hopefully you added a subject to appraisal or something in your contract, so that way you're not stuck or getting sued. So you have a subject to appraisal, and then what's going to happen is that you're going to have to have the purchase agreement or the offer modified down to the amount that of the appraisal's opinion. So or you can just pretty much suck it up and just come out of pocket an extra $5,000 if you really want the home per se and think that it's a really good investment and it meets all your criteria. That can be done too as well. I've done that once, where I knew that I would be making a good, very long-term investment. Went through a mortgage broker, and the company's or lender that the mortgage broker connected with pretty much said that the bank order appraisal came in at $55,000. So the seller, for sale by owner, wanted $60,000. So I pretty much contracted with the seller to buy his home at $55,000, and then just come out of pocket an extra $5,000 cash for my primary home for a short time until it got converted over into a rental. And now today, that particular home is worth 3 times what I paid for it, and I've held on to the property for at least 15 years as well. So there's a little bit of inflation adjustment in that numbers, but however, you see the appreciation and the equity that's there that can be used to buy other properties, or cash out, or home equity line of credit for other purposes like repairs and maintenance, etc. So number 4, title search and title insurance. The lender doesn't want to lend money for a house that has legal claims on it. That's why a title company performs a title search to make sure the property can be transferred. So the title company will research the history of the property, looking for mortgages, claims, liens, easements, zonings, unpaid taxes, restricted covenants. Title ensures guaranteed accuracy of its research. In some cases, 2 policies are issued: one to protect the lender, that is almost always required, and one to protect the property owner, optional but can be worth getting. Another thing too on title, or in some states escrow, what you want to think about too when it comes to this, you definitely want to have yourself covered with the optional. To me, it's not optional. It's a must, because you definitely you never know, something might come up where somebody's saying that you have an easement on their property, or someone may say their fence line is actually a little bit more towards on goes on to your property, so so proper survey or something like that needs to be done. But anyway, you definitely want to make sure that you have title insurance for obvious reasons, and also if you have the property's title within, or trying to get the top property's title within a trust, it's also good to let the title company know that as well, so they can do the proper paperwork, so that way your property is properly placed in your family trust. Okay. But if you don't want it to be, if your title is in a trust or will be in a trust, and you don't have to, you can let the lenders know that that you want the mortgage in your own personal name instead of the trust name. Okay, so, or the name of the trust. So number 5 is underwriting decision. So this is the last step. So once the underwriter thoroughly reviews your application, the best outcome is that you are approved for a mortgage. That gives you the all clear to proceed to closing on the property. However, you might receive one of these decisions instead: denied. If your mortgage application is denied, you will need to understand the specific reasons for the denial, determine your next steps. If the lender thinks you have too much debt, you might be able to lower the DTI ratio by paying down credit card balances. If your credit score didn't make the cut, recheck the credit report for mistakes and take steps to improve your score. you could possibly apply again in a few months. Apply for a smaller loan amount or try to assemble a larger down payment to compensate. Suspended. This might mean some documentation is missing from your file, so the underwriter can't make an evaluation. The application could be suspended if, for example, the underwriter couldn't verify your employment or your income. So the lender should tell you whether you can reactivate your application by providing additional information. Okay, approved with conditions. Mortgage approvals can come with conditions such as the need to furnish additional pay stubs, tax forms, proof of mortgage insurance, proof of insurance, or a copy of a marriage certificate, divorce decree, or business licenses. So once you clear any conditions, you get your mortgage approved. Your home is almost complete. Your home purchase is almost complete. The final step is closing day, which is when the lender funds your loan and pays the selling party in exchange for the title to the property. This is when you'll sign the final paperwork, settle any closing costs that are due, and receive keys to your new home. In this process as well, in this article, they didn't mention that most states you may not have the option of doing an e-notary or being able to sign your or notarize or sign your final closing documents electronically. So you will most likely have the title company. They will schedule a notary to come out. Most likely that notary works within the title company or is an escrow officer who is a certified notary, public notary, and they can come out to your home and you can give them any specific instructions that you may have, and they will come there and do your fingerprints and make copies of or you can already have ready copies of your IDs, preferably a driver's license or state sponsored or issued ID, but it can be any form of ID that has a photo. And that's pretty much, you sign their book. Once you completed signing all the documents, normally the bank will send you the documents in advance, an electronic copy. And they will send it also to the notary around the same time. So that way you both get a chance to read every single document, every single page thoroughly to make sure there's no errors, everything is good to go. Because when you sign, the most important thing I think you should pay attention to is your name or the names of the individuals that are on the mortgage, because when you sign the notary, when you sign, the notary sees you sign, it has to match your ID. The documents have to match the name, the document and your IDs have to both match. And then your signature has to match. So if you have a middle initial, but the document doesn't have a middle initial, don't sign with a middle initial. Make sure you sign, right, your first name and last name, exactly how it is on your ID and exactly how it is on the mortgage closing documents. So that's a little tip from experience. So anyway, thank you for listening to this long video. But I think it's very important to understand how the mortgage process or mortgage underwriting process goes, because this is one of the things that a lot of newbie or new home buyers and investors, it's valuable information for them to be able to prepare for buying a home, especially in today's current market, where there's really high demand and you have to go out there and compete with a lot of buyers who are also first-time home buyers or investors or people who's looking for another or second home or so. So, or people who are renting and looking for they're looking for an looking for a house. So there's a lot of competition out there. Not to say that there aren't other ways to be able to purchase a home besides the retail market, but or MLS, multiple listing service. There's other ways to buy a home, but say you found the community, you found the home that you want to live in. You just have to be prepared in today's market and environment where it's a seller's market, especially in most cities and around America or U.S. I'm not sure about worldwide at the moment, but within America, a lot of migration, a lot of the pandemic, shortages, inventory shortages. So many different events are happening now to cause low interest rate environment, to cause a lot of demand when it comes to housing. So those individuals that can do all cash or have a pre-approval already set up and have all their documents and everything in order, that can move fast, those are the ones that have a better shot at being able to get that house that they're looking for at the price that they're looking for. I highly do not recommend competing with other buyers, or sending love letters and all these other wacky or crazy things. But what I do suggest is just making sure that you have all your documents ready, making sure you have all your ducks in a row. Don't take on a whole bunch. Don't go out and buy a new car, or take out a big loan and buy a new car or television, or go into like some big major debt on your credit cards or loans and things like that when you're applying for a mortgage. And if you did, at least wait 3 to 6 months before all that clears up a little bit, so that way you can go ahead and apply for a mortgage, so it doesn't really affect your debt to income ratio and other conditions as much. But there you go. That's the underwriting process in a nutshell. Thank you. And if it's your first time to my channel, hopefully you like this content. Normally we do a lot of chess related content on my channel, but I'm trying to expand my channel to playlists to include other areas that are my passions. So real estate is one of my passions, or real estate investing. So we'll go ahead and talk some more about real estate, and we'll talk about other topics that are near and dear to my heart, and or passion projects, that you could say. And hopefully I'm providing good content and value to yourself, so you could view more often, like, subscribe, share, help this channel grow, and have a nice day, have a nice weekend.